Hello, this is Ken Himmler, and I'm here to talk about the recent market drop on Friday of 1.5% on the Dow. I'm starting to see a lot of the questions flood in on what do we do? Here we are, and the Fed is now saying that inflation is so far in the problem zone that they're going to think about raising interest rates again. So a lot of people are a little worried about what will that do to the real estate market? What will that do to the stock market and the bond market? So I'm here to answer those questions for you as I see it. In my opinion, after 40 years, while I don't have a crystal ball, I can tell you after running many years of the econ map and being about 80% on track with the trends. Now, again, I can't pick exact timings, but let's just talk about the macros for a minute and how that might affect what your portfolio does. If, and the rationale as to why the jobs report came out so well is that people are anticipating a huge uptick in hiring. They've already started hiring, knowing that when Trump gets in, a lot of the tax brackets will go down, regulations will drop, not completely, but I think we all would enjoy seeing less regulations and a little bit more free capitalism in the markets. So the job report was not what any of us expected, with a couple 100,000, 3 or 400,000 new jobs posted, way over what the estimates were. But let's not take this knee-jerk reaction as to what most people do when the market has either a real up and they get FOMO, like they're missing out on something and they make a bad decision, or the opposite is there's a slight adjustment in the market and then they think the world is crumbling. What is that story? Chicken Little, the sky is falling, right? But let's just play this out and talk about what this might look like. So if companies are hiring in a big way, so you see the initial job report from the Fed standpoint, they say, well, inflation's not going to come down with this many people now working. They were hoping, most people on Wall Street, at least short-term thinking, was hoping that the jobs would be down, the unemployment rate would go up, people would have less money to spend. But there's other things and factors here about inflation. First, Trump is going to get away from this free money giveaway, just giving money away, billions of dollars that are untracked for illegal immigrants, money here, money there to do whatever they were doing. It's a different realm over in the next 4 years, different administration. So we don't have that kind of free money flow that people can go out and freely spend. So just because jobs increased and people are a little worried about inflation, what happens in 6 months? Well, now companies have hired. There's less regulation, less tax. There's more velocity of money effect. The VOME is something I talk about a lot. And I sent out a post and talked about the VOME because the velocity of money, what most people don't see is they see the short-term effect. It could be taxation. It could be a reduction in taxation. It could be any of these things that causes money to flow faster. When governments give out money, the money stops because you have a short-term flow of money. Because when that money runs out, it's all over and people have less to spend. However, when people are able to employ themselves, while the short-term effect doesn't look great, what ends up happening is profits go up in the companies. If you asked me for a reasonable estimate, well, probably the next 3 to 4 months, based upon what that job reports came out at, we'll probably see an increased amount of volatility and even probably a small depression in the stock market. What that means is 6 months to 9 months to 12 months in our 2025, we'll start to see companies reporting bigger profits. People will start spending more money, but it's sustainable money. It's not fake money being printed for the short term. Once those companies start showing a bigger profit, interest rates are overridden by profits and future growth perspectives. Secondly, if you watched my end of the year, my 2024 in review, and what we were doing in 2025, I clearly stated that we plan on keeping our long-term bond positions. I did not plan on moving back until interest rates came down at least 100 to 150 basis points, 1 to 1.5%. With interest rates going up, my stance is even stronger now that we stay the long bond route. Why? We don't buy individual long bonds. We're buying bonds within an ETF. It's what I call a rotating portfolio. So if you think about an ETF, and let's say that they're investing in long-term bonds, they might have 1,000 bonds, 500 bonds, all with different maturity rates. As those bonds mature within that ETF, they have to buy a new bond. If they're in fact buying a new bond and interest rates stay where they are right now, they're buying a new bond at the higher rates. This gives us more interest, more present value and income. But what it also does is and I do believe when is now just delayed a little bit, but when interest rates come down, the bond values themselves will grow in a huge way. So again, after 40 years of seeing all kinds of market volatility, wars, terrorist acts, interest rate craziness, the pandemic, 1986 Tax Reform Act, the financial crisis of 2008, rest assured, this is a small blip in a long-term strategy. I would not make any changes in our plans or your plans if you've been following my portfolios for years or decades, which have successfully come back at a very competitive risk-adjusted return. And that's because we are mixing asset classes, such as I'm mixing in REITs, I'm mixing in, now some of the things that we have done recently is I've mixed in data centers, AI, some cell phone towers, and certainly some of the evolving technologies, such as now Starlink is going to be able to connect with every single cell phone in the world. So there are some things that we have changed as worlds change, as our lives change, which is if there's anything inevitable, it's going to be change. So the composite of the stock, the bonds, and the REITs is going to stay the same. Don't fret. I would not worry. I can tell you if I get on a video and I tell you I'm worried, it's probably time to worry. I am not worried at all. There's going to be the normal volatility. The bonds will stay. And I do believe, here's the one good thing, I do believe that I was reading a recent study about what's called silent quitting. I'm an old guy. I don't know what silent quitting is, so I delved into this analysis that these researchers did. And the analysis said that during the pandemic, more than 50% of people worked from home. A year or two after that, that dropped to about 25 to 30%. It's held. Now, there's conflicting ideas on the actual percentage because some people that are hybrid, you just can't tell 100%. But what we do know is this. We do know that those people, and still, if you read it, it's somewhere around 20 to 25% of the population is still fully remote, have not fully returned to office. And if you've been reading the articles about Amazon, Google, Facebook, Salesforce, all these CEOs that at the beginning thought remote was the best thing in the world, they have all changed their minds. And they've said, you must return to work or you will lose your job. Now you might wonder why. Are they just being ridiculous? Well, number one, they have learned that this silent quitting has happened. It's actually statistically shown that out of the polling group, out of the statistics they were tracking, is 49% of remote workers have silently quit. Now you might wonder, like me before I watched that or read this, what is silent quitting? Well, this is where the office worker, that if they're in an office environment and you walk by their cubicle or their office, you see they're working. They're physically working. They knew when they're at lunchtime. They knew when they clocked in, when they clocked out. And you had some, I want to say some controls, some bumpers, some lanes that everybody would stay in. There was more intercollaboration. There was more, bottom line is productivity. So one of the things I think has really hurt our country as well as our stock prices is this whole remote working situation. And I think these big companies have recognized that. It's made commercial real estate just an absolute horrible asset class for the last 3 years. And so you have all these massively empty office buildings. So when some of these bigger companies force this return to work, we're going to see commercial real estate rebound in a big way, because that's just been pretty much put on hold for 3 to 4 years now. But what we're also going to see is a lot more productivity. You're still wondering, well, what is silent quitting? Well, this is what I read. Silent quitting is where that person goes to work at home, and for the first 6 months, statistically, they work in the same type of environment that they were working in an office. They show up on time, they're doing productive work, etc. But then they find out, wow, my boss doesn't know what I'm doing. My company doesn't know what I'm doing. And there's actually websites out there that these types of workers can visit, and they teach them how to scan the system, how to make their mouse move, how to use AI to put a face on a meeting, and all kinds of workarounds to not show that they're actually working or productivity. So silent quitting is another part of that. It's where they do the minimal amount of work. They don't do anything more, just enough to keep their job. So again, they're talking about 49%. And again, it depends on what study you read. But there's a gross amount of lack of productivity. Now, the bad part is you get some people that work remote, and they're doing 150% more than they might have done in an office because they don't have the distractions. But almost half from these studies are showing that the people that do work remote lose about half of their productivity. Why? Well, now they're out for lunch and they're saying that they're working, and they're clocking in on their remote devices. They're out and maybe on a golf course, and they can book in that they're, in a video meeting. So there's no way to track that. And obviously some people have taken advantage of that. So one of the things I'm looking forward to in this year is hopefully the mandate from some of these larger companies to return to work, return to an office environment. That, along with reduced regulations and less free money going out, because look, if you're sitting at home working, government's giving you all kinds of subsidies, and there's no way that you can track. You're just inviting, it's not all, but a lot of people to just take advantage of the system. So by returning to work, eliminating that government subsidy, that free handout, I believe our productivity is going to soar. By the way, our national productivity is at its lowest point in the history of our country. We have never, ever been this low at productivity. Other countries are kicking our butt. China, Taiwan, etc., Hong Kong. These guys, they're still working 100% capacity. And we're somewhere around 60 to 65%. And we have always been a country that has outworked everybody else until the pandemic. So, in summary, if you really want to know what to do in this year, stay tight. Don't sell out of the stock market. Don't sell out of the bond market. Don't get afraid of the real estate market. Make sure that you have a good, solid financial plan in place. Stay the course. I believe, while I don't have a crystal ball, but I believe if you do that, you might at the end of the next 2 to 3 years see some of the biggest gains that you've probably seen in history. With that in mind, I'm going to conclude it, and I'm going to cap it off with one additional thing. If you're in Vegas and you are available on January 29th or January 30th, I'm going to be there at a speaking event, and there are a few seats left. And so all you have to do is just email to, ready, here's the email address, events at onewealthmap.com. So the word events at one, and one is spelled out O-N-E, wealth map, M-A-P.com. So events at onewealthmap.com. Depending on when we get the email, there might be some reservations left. If not, I'll have to let you know the next time I have a speaking event. With that in mind, stay the course this week. Ken Himmler signing out.